All right. Good morning, everybody. TGIF. Non-farm payrolls today. We've been waiting on it all week. We're still in the regime that bad news is good and good news is bad. And that's what the market's been reacting to this whole week. The idea that if we continue to get good news, the Fed doesn't have a reason to cut and that will remain higher for longer. Now, there was some talk about cutting just because, and that they didn't necessarily need a reason to cut. And it seems like the market may have just forgot that. I would say that markets do what they do, and talking and bobbing heads try to attach a narrative to it, whether that narrative is actually true or not. So maybe it's just one side of the coin, right? That it really doesn't have to be a reason necessarily for it to be down, but we'll take it, right? The Russell is down the most at 1%. Japan is down the least, and behind that, the Dow 30, S&P 500, and then the NASDAQ at 0.25%. Hong Kong sitting somewhere in the middle, a little more than 0.5%. We continue to see a capital rotation, a pullback, and the money flow drying up a little bit. We also have ISM services today at 10 o'clock, factory orders at 10 o'clock. But by lunchtime, I think we're going to be good to go, because that rig count really won't be anything we need to worry about. So I'm pretty confident that by lunch, whatever we've got, we're going to have for the day. Shouldn't see any more surprises going into the close, which is nice because that gives us a chance to do 0-day trades in the afternoon on everything that has weeklies. I know 0-day traders tend to always focus on the SPX or the S&P because you got 5 a week, but the tactics for trading 0-day work on anything that has options expiring today. So something to think about. They mentioned gold here consolidating in a tight range. That's worth keeping an eye on. We had that nice pullback as US dollar Japan was moving up into that 145 resistance. But if we get into that resistance and get strongly rejected, like we're anticipating it's going to do, that strong rejection is going to be a beautiful lift for precious metals, especially gold. And we should come off of that support level and out of that consolidation nearly like a rocket ship. So I think that might be one worth a little bit of attention. Volumes within normal range, but we do have a market maker move. They're hedging this morning against the potential of an adverse reaction. That kind of gives you a feel for how important today's data is. If they weren't worried about it, they wouldn't hedge against it. We've already made it to the ADR half. And since we've already made it there so early this morning, that now opens the door for us to go to the other side of the ADR. There's something that is worth keeping in mind. I'm not going to take credit for this because it's not my work, but there is a 50-50 chance that the market will change direction within the first 30 minutes of the trading day, no matter how bullish it is, or no matter how bearish it is. And that's something to really keep in mind when we get into the open and you get a day like yesterday where it was a really strong push to the upside. No matter how strong it is, there's always a 50-50 chance of it changing direction by 10 o'clock, which is pretty interesting. You know, when you start digging into open range strategies and how they can turn into swing trade strategies. And the idea that if it doesn't change direction in those first 30 minutes, that the statistics for it to stay on course and continue going in the same direction increases substantially. So it may be a little hard to see because of their broken up pattern. But here's the 10 MA and here's the 20 from the daily time frame. So it's like having a daily chart with your moving averages on it. Price has cut through the 10 and the 20, and we're getting really close to the 10 going underneath the 20. That'll be a crossover signal. We don't have it yet, but it's a start. There's a channel top. $44.61. So if we continue this downside drive, it wouldn't surprise me if we end up tangling into that. There's a cog line at 47.11. Remember, all the 11s are a cog line. It's a COG, center of gravity. Now, if you go searching for that on Google, center of gravity, you're going to come up with very likely something that John Euler developed years ago. But that's not what we're discussing, right? He developed an indicator called the center of gravity. This is not an indicator. This is a concept. And it's supposed to be a validated level that you go in and you do the work to validate a particular area. It takes weeks of crawling through the numbers trying to validate that level. Not all of the levels have been validated because, of course, after a while, you get tired of doing all that work. The ones that we have evaluated kept landing on 11, 32, and more recently 92. So rather than doing all of that work, we just assume that that is a cog line until proven otherwise. And it hasn't let us down, so I continue to do it. We opened underneath the daily pivot point and the daily channel, or the pivot point channel, however you want to say it. This is the channel, and you can see the purple line inside of it called the daily pivot point. It's a mathematical formula. High-low close divided by 3, and the channel is derived from the previous day's trading range. When we open underneath it, we have an immediate bias of bearishness. So we want to look for short trades, not long trades. But at some point, we have to start working our way back up because otherwise all markets would just, continue to go down forever, and that doesn't fit. So at some point, we have to flip the bias over. We've already B-bottomed, set up a really nice drop base rally. So unless we recross the proximal line down here, then we got to assume we're on our way back up. got the VWAP, got a half back to break. Then we have yesterday's lows to break, 47.26. The IB, which is the initial balance, so here's the open at Globex at 1800. Top at Globex, all those levels to the upside. To the downside, we have a voodoo line here, 4705. Then we have the round number, 4700, and a full ADR, 4690. And there's a cog line, 4692. So we'll just suppose that today we get some negative news and we begin expanding to the downside. We have a market maker move. It's telling us that not only could we move our original average daily range, which is that yellow line, we could move down for a total of 0.9% to the downside, but we could also go another 0.5, even lower than that. So just for some easy math, we can expand this, and it takes us down to this next voodoo line. $46.66. Now, I didn't do the math and make that perfect because it doesn't have to be. That's pretty darn close. That's how far we could go today, and it still wouldn't be considered an outsized move. 46.66 is basically the bottom of this area back here where I said we had a channel top for a gap close. It's just above that level. So if we overshoot that 46.66, then we're very likely going to hit this channel top. And I don't see that we get out of this channel top by the end of the day. I don't care how bad the data is. It would have to be some news beyond the norm to get us out of that today. Now, you know, on the SPX, the number might not be the same, but the chart pattern will be the same. You could find some out of the money credit there for a Friday. Not really interested in that kind of trade, but I mean, it is there. To the other side, if everything turns around and we start going to the upside and we get through our ADR full, we could expand the additional distance due to the market maker move, and that would get us up to 4,800. That's a pretty impressive number. It would also be getting us back inside the previous week's range. That'd be a reasonably decent recovery, right? We're talking about getting all the way back up inside of this candle. That would be a TRB setup, right? Now, normally for a TRB, we would base down here first, and then we would work our way up. But we can just jump the fence and run back up again. There's no way to try to decide what the market is going to do when this data comes out. It's a fool's game to even try to hypothesize which direction it's going to go. You're better off building a plan for both, getting the data, seeing the market respond either long or short, and then putting your plan into place. This move to the upside, by the way, if we were to get it, would have to also cross through all of those moving averages that I had already mentioned. So there's just a lot of resistance overhead. And it's not to say we can't cut through that resistance, but it's going to be a long road to hoe. $10-day, 30-minute volume profile. We have broke that low that has been holding for quite a while. Expanded to the downside, really shallow. We're not seeing any indications from this chart of an iceberg down here. The point of control did get moved. Like I mentioned, it probably would once we lost this middle volume. So now we need to spend enough time in one location down here to move this point of control down to us. Otherwise, we're going to need to go back up and chase after it. It's reasonably shallow if we did need to work our way back up, but I mentioned there's a lot of trash overhead that we would have to fight through. This trash is a part of all of that. So anything above 47.50 is just going to be a fight. And again, sure, we can get there. We can do it, especially if it's a market caught off sides and they're all, scrambling to swap. But just for a grind back up, that's going to take some time. We're very likely going to need to correct in time rather than have a price correction. We got a new VPOC now. Yesterday it gave us one. $47.42. If we make our way to the upside, is yet another area that we're going to have to fight through. Just add it to everything else that we have, right? So VPOC, all this is the point of control, and it hasn't been hit yet. That's it. There's no magic to it, right? Point of control is where the greatest amount of volume happened in the time being measured, and that's yesterday. We're doing a full day on the profile. So the greatest amount of trading activity happened right there, 47.42. It's volume by price. In blue here, we have volume by time. So TPO profile versus volume profile. They're not the same things. Notice the point of control this morning on the TPO is still across these highs, but the volume is down here, the volume profile. The distinction for this, or the reason for this, is that by price, we've put in more volume at these lows than we did up here. But we've spent more time up here than we did down here. Now it's building out. It's getting close. This point of control is likely to shift down here soon. But we use this TPO to try to find icebergs and ceilings to see if a price point wicks down into an area that we haven't really spent a lot of time at, and yet we still found a lot of volume there. We've already got the new week. Now this new week is not set in stone. It won't be until 4:15 tonight. But we can see the new week already, which is nice because we can already start to gauge what does next week look like. Today, we're ending a short week, and next week will be the first full week we've had in a little while. This is also, so far, looking like we're going to end the week outside of this box, which will be the first time we've done that in 3 weeks. So one of the questions we want to ask is, does the volatility next week seem to be greater than the volatility that we had this week? Is the range the same? Well, a generic way of asking that question is just to draw the box on our current week and shift it over and put it on the new week. And when we do that, we can see that next week is bigger than the week that we had. But we're not done yet, because the week that we just closed was only a 4-day week, and next week is 5 days. When you add more days, you add the opportunity for price to make a bigger move. The range automatically is bigger because we have more days. So even though the box is bigger, it doesn't necessarily mean that there's more volatility there. Not at first glance. It very likely is just showing an extra day. Unfortunately, there's no way to tell other than trying to go in and identify by hand the range for the week. This is the number that it's using. 74 points higher than the close, 74 points lower than the close. Gives us nearly a 150-point range. Now, if you used the go back and you were able to go back to last week and look at what a 7-day range was, even though it only marked a 6-day range, right? Because we were 1 day off. If you were able to identify that 7-day and see if it was greater or less than $74, then you would still have an idea if we're pricing in an extra day or if we're pricing in more volatility and an extra day. If we start recovering today and begin moving to the upside, getting back inside that box is going to be my target. We're still more than 1.5% above the 10-week. Now we've been working our way back down, but again, it doesn't owe us a full reset, so we don't have to come all the way down and get to zero. The fact that we're still holding above the 10-week really is what counts. And keep in mind, the 10-week is really a 50-day. It's not a perfect overlap, but in your mind, it should be the same thing. 10-week, 50-day. So we're talking about the S&P getting back down to the 50-day moving average. That's a really big deal. We are 1% below the 10-day moving average, so we've already crossed under. We haven't moved too far, too fast. It doesn't owe us a pullback. We're not due to bounce just because of how far we've moved. This isn't as deep as we've been before. It's not even close to any of the reversal zones. We would need at least one more 1% move to the downside before we'd even begin to consider that we've traveled to the downside fast enough to warrant some mean reversion. So it's all going to come down to the data today. Optionality isn't going to matter. Pivot points won't matter. And no matter what is up this morning, what's that? Or what is down this morning, once the data comes out, all of this could flip over, or it could just get stronger with what we've already got. So there's no real reason to dig it deep into whatever's moving this morning. You just wait for the data to come out, see how it's going to affect things, kind of keep in mind the difference between growth and value and the rotation that we've been seeing over the last few days, last week. Kind of focus on some of the bigger plays. We can see US dollar Japan got into that 145. It really tried multiple times to get through this high that was set, starting to fail. We just got a lower low. If we can break back below this 145, but even better, this 144.9, then I think we can start working our way back to these previous levels. We should be able to get a bump out of gold or precious metals, maybe both. Be very careful. We got the 10-year continuing to head to the upside, and it's doing it alone. It doesn't have the dollar with it. And we got to get those data points, right? So no matter what the data does today, by 10:30, maybe 11, because some of this data is coming in a little later in the morning. You should be good to go at that point. You see the latest data point, 10 o'clock. Within 1 hour of that, you should have a pretty good feel, you know, if we're going to continue the rotation or not. And then we get into the weekend. So everybody, be careful, be safe. Have a good weekend. I'll see y'all next week.